Welcome to Capital Conversations. I'm Glen Gould. Today we're tackling a problem every staffing and temp agency knows too well. Payroll is due before client invoices are paid. Over the next half hour, we'll map the practical playbook, payroll finance, factoring, PEOs, blended credit, that founders use to scale without breaking the payroll. Joining me are Maya Torres, founder of Riverbend Staffing, who grew a regional firm from 15 to 220 employees, and Marcus Lee, VP of Specialty Finance at Harbor Capital, who underwrites payroll and receivables deals across the staffing sector. Maya, Marcus, welcome.
Quick promise for listeners. By the end of this episode, you'll have a practical decision rubric to choose the right product by revenue and margin profile, a documentation checklist for fast underwriting, and 3 negotiation scripts you can use when talking to lenders or factoring firms. We'll start with backgrounds, and then move into the cash conversion diagnosis, the funding toolbox, deal structure, and finish with a case study and grab-and-go checklists. Let's dive.
Maya, tell us how Riverbend started, the typical margin and payment terms you ran into early on, and one funding misstep that taught you an important lesson.
Thanks, Glenn. We started as a temp-to-hire shop focused on healthcare and light industrial staffing. Early on, our gross margins were tight, usually 12 to 18% after payroll, taxes, and workers' comp, and many clients were on 30 to 60-day terms. So every week, we'd be bridging a growing payroll runway while waiting on receivables. My big misstep was assuming a bank line based on our receivables would be enough. The bank underwrote on aged AR, but didn't want to finance unbilled wages or payroll taxes, and suddenly our pay cycles collided with client payment delays. We learned we needed a product engineered for people cost timing, not just a traditional AR line.
Marcus, from the lender side, what do you see as the primary timing and risk exposures for staffing firms that founders sometimes underappreciate? 2 big issues: mismatch on timing and client concentration. Mismatch means payroll, taxes, and benefits hit daily and weekly cycles, but collections follow client invoice cycles, sometimes net 60 or longer. That creates persistent working capital draw. Client concentration is a credit risk. Losing one large payer can blow out coverage. Lenders also watch co-employment and compliance. Misclassified workers or missed payroll taxes create material legal and repayment risks. We underwrite to cash flows that match payroll cadence, and we often require visibility into payroll runs and client payment behavior.
Let's move to the toolbox. Walk us through the primary funding options staffing firms use, how they actually work in practice, and the typical pros and cons founders should weigh.
Start with invoice factoring. A factor buys eligible invoices at a discount and advances most of their value immediately, often 70 to 90%, holding a reserve until collect. Pros: fast cash and off-balance sheet flexibility for AR. Cons: cost can be high for low-margin accounts, factors want control over collections, and you may face advance rate caps on payroll-heavy accounts. Payroll finance is different. Lenders advance funds specifically to cover payroll and payroll taxes, typically secured by a lien on receivables and sometimes personal or corporate guarantees. It aligns with payroll cadence, but often requires tighter covenants and real-time reporting. PEOs remove payroll burden entirely by co-employing your workers. They handle payroll, benefits, and taxes. That simplifies operations and improves predictability, but margins shrink because the PEO charges for services and may limit control. Finally, blended solutions combine a smaller bank line, payroll finance for immediate payroll runs, and factoring for older receivables. That structure can lower overall cost while preserving working capital.
We used that exact blended approach. Early on, we tried pure factoring, and it solved cash flow but shredded margins. Switching to a smaller factor advance plus a payroll facility for weekly wages and a PEO for a subset of contingent workers actually reduced our blended cost and simplified HR compliance. The trade-off was more reporting and a few tighter covenants, but it let us bid new regional contracts without hostage cash flow. If I had to summarize, pick the product that matches the timing of the expense you're trying to cover. Payroll needs payroll finance, not just AR financing.
Marcus, founders often ask, what are the negotiation levers? Pricing is one, But what else can they push on to get a better deal or reduce friction? You can negotiate advance rates, reserve release cadence, and reporting frequency. Offer stronger controls to reduce perceived risk. For example, lockbox arrangements, automated posting of client remittances, or client notification to the factor. And lenders will often improve pricing. Also negotiate audit scope and frequency. Propose quarterly, not monthly audits if your controls are solid. Another lever is term and covenants. Shorter-term loans with clear renewal triggers can be cheaper than open-ended facilities. Use a negotiation script. State your ask. Show mitigant. Propose a middle ground. For example, we'd like an 85% advance rate on private pay clients. In exchange, we will implement direct deposit lockbox and provide weekly remittance reports. That shows you're solving the lender's concern while getting better economics.
That script worked for us. We offered weekly remittance posting and agreed to a proof of payment sample for the first 2 months to secure a higher advance. It was a small operational lift that delivered meaningful cash earlier.
Let's get concrete with a case study. Maya, walk us through the blended deal that funded your regional expansion, key terms, timeline, and the lessons you'd pass on.
We needed to open 3 new branches in a year. Payroll obligation jumped before we onboarded new clients. The deal, a payroll facility sized to cover 2 payroll cycles, about 1.5x our peak weekly run rate, plus a factor for 60-day invoices on a select client cohort. Advance rates were 75% for payroll-eligible receivables and 80% for select private pay clients. Covenants included a maximum client concentration of 30% and weekly remittance reporting. Timeline, due diligence and controls implementation took 6 weeks. Funds were available immediately after. Lessons, prepare clean payroll tax records, get client acknowledgement letters early, and be ready to automate remittance reporting. The technical lift is worth the faster funding.
To add, lenders will move faster when you deliver a tight documentation package. My recommended checklist, documentation that speeds approval, includes 90 days of bank statements, 3 months of payroll journals, client contracts with payment terms, proof of insurance, payroll tax filings, and a client aging report. Also prepare a simple cash model showing payroll runs, invoice days outstanding, and use of proceeds. That little model answers our basic risk question in 1 page.
Marcus, can you give listeners a compact decision rubric? When should a founder choose factoring versus payroll finance versus PEO versus blended solutions? A quick rule of thumb would be great.
Sure. Brief rubric. If margins are above 20% and client terms are 30 to 60 days, factoring can work, but watch cost. If payroll is weekly and margins are 10 to 18% with uneven receivable timing, prioritize payroll finance or blended facilities because you need cadence alignment. If you want to offload HR risk, have smaller margins and lots of benefits complexity, consider a PEO for some worker populations. Use blended approaches when growth demands capacity, but no single product fits the whole gap. Always layer controls and price with your margin profile in mind.
I'll finish with 3 rapid recommendations for founders. 1. Map your payroll cadence versus receivable days and quantify the weekly cash gap. 2. Prepare the documentation checklist Marcus mentioned before you shop. 3. Test a small pilot with a provider to validate operations and pricing before you scale. Those 3 steps will save time and protect margins. Great. To recap, diagnose the timing gap in weeks, pick the product that matches the expense cadence, negotiate operational mitigants to lower pricing, and prepare a tight documentation package to speed approval. For listeners, we'll publish the decision rubric, documentation checklist, and negotiation scripts from today's episode. If you run a people-heavy business and payroll keeps you awake, start with the cash model and 1 pilot product. If you found this episode useful, subscribe to Capital Conversations for more interviews with founders and lenders who tackle funding challenges head-on. Visit our show notes for the checklist, the rubric, and sample scripts. Keep building. Let's talk capital. Until our next conversation.
Thank you for joining us on Capital Conversations. I hope today's discussion provided valuable insights for your funding journey. Remember, securing the right capital is a crucial step in building a successful business. Keep building. Let's talk capital.